IRAs and Roth IRAs are both retirement vehicles. Both have funding limits and both provide tax-advantaged savings for retirement. So, what's the difference? In this video, we'll discuss some of the key differences, including tax-deferred versus tax-free growth, earning and funding limits, tax benefits, early distribution options, required minimum distribution, and investment options. Traditional individual retirement accounts, or IRAs, provide a tax deduction when the contribution is made and allow tax-deferred growth. This means that if Joe saved $1,000 into his IRA for the year, he would not pay tax on the $1,000 he saved. As long as the money stays in the IRA until after age 59 and a half, with a few exceptions, Joe will not be taxed on the growth along the way. When Joe takes distributions in retirement, he will be taxed as the funds are withdrawn. Roth IRAs do not provide an upfront tax deduction when the contribution is made, but do provide tax-free growth. This means that if Sue saves $1,000 into her Roth IRA this year, she would pay tax on the $1,000 she saved, as long as the money remains in her account until age 59 and a half, again with a few exceptions. She would not be taxed on the growth along the way. Additionally, she will not be taxed when she takes distributions later during her retirement. Traditional IRAs and Roth IRAs each have a $6,000 per year funding limit with an additional $1,000 allowed for anyone over the age of 50. The funding limit is cumulative across both types of accounts, so you could save $3,000 into each account, $4,000 into one, and $2,000 into the other, or any combination that does not exceed $6,000. Additionally, to be eligible to contribute, your earnings must be equal to or under the threshold. If you are married filing jointly, the phase-out income level for Roth contribution eligibility is between $196,000 to $206,000 in 2020. Once you exceed this limit, you no longer qualify for any Roth IRA contributions. For single filers, the phase-out is between $124,000 to $139,000. The phase-out rules for traditional IRAs work a little differently. Anyone can contribute to a traditional IRA regardless of income, but if you or your spouse have a retirement plan through work, then you are subject to an income limit which will determine if your contribution is deductible. If you are single and have no retirement plan through your job, or if you are married and neither you nor your spouse have a retirement plan through your jobs, then you are not subject to the income limits. If you are single and have a plan through work, then the phase-out for deductibility is $65,000 to $75,000. If you are married and your spouse has a retirement plan through his or her employer, then your phase-out is between $196,000 to $206,000. And finally, if you are married and you and your spouse have a retirement plan through your employers, then your phase-out is between $104,000 and $124,000. Remember, you can still contribute if your income exceeds the phase-out limits. You just won't be able to deduct your contributions. As a general rule, you do not want to access the funds in your IRA or Roth IRA until after age 59 and a half, as you would be charged a 10% early withdrawal penalty in addition to owing income tax on any distributions from a traditional IRA or any gains in a Roth IRA. There are a few exceptions that would allow you to avoid the 10% early withdrawal penalty. It's important to note that any taxes due will not be avoided even if you are able to avoid the early withdrawal penalty. For traditional IRAs and Roth IRAs, you may be able to withdraw funds and avoid the 10% penalty if the withdrawal is to pay for your medical insurance premiums after a job loss, to pay for medical expenses that are not reimbursed by health insurance and exceed 10% of your adjusted gross income, to pay for some college cost for you, your spouse, or your children, to cover up to $10,000 towards a first-time home purchase, if you are disabled and unable to work, or for active military service. Roth IRAs work a bit differently when it comes to your basis, which is the amount you saved into your account. You may be able to withdraw your contributions for any reason without taxes or penalty, after the account has been open for 5 years. Remember, this does not apply to the gains, as they will follow the rules we discussed earlier. Once you retire, traditional IRAs and Roth IRAs have different required minimum distributions, or RMD, rules. Traditional IRAs require you to take withdrawals each year starting at age 72. The government puts out a table to use in calculating your yearly distribution requirement. Roth IRAs, however, are not subject to RMDs and do not have to be distributed at any age during your retirement. Both are the same in that traditional IRAs and Roth IRAs each have to be liquidated within 10 years if they are inherited by a non-spouse. Investment options vary widely from conservative to balanced to more aggressive options. Some of the more common choices include mutual funds, index funds, CDs, money market accounts, fixed or variable annuities, stocks, and bonds. This is not a comprehensive list, as there are a wide range of investment options allowed by the IRS. It's best to speak with a CFP or other financial professional when deciding what kind of account to open and what kind of underlying investments may make the most sense for you. If you enjoyed this video, don't forget to like, comment, and subscribe. We'd love to hear ideas for topics you'd like to see covered. As always, thanks for joining us.